What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about the biggest tax mistakes that I see real estate investors make and tips on how to avoid them. As a quick note before we dive in, this podcast is for educational purposes only. I'm not your CPA, although I am a CPA. Either way, make sure you're talking to a qualified professional about your specific situation before trying to do anything that you hear on here. So the biggest mistakes that I see real estate investors make, I came up with this list and we're going to dive into it, not in any particular order, but let's go ahead and get started. So the first one is commingling of funds. So this happens a lot, especially to new investors. So this is when you mix personal funds with your rental funds. If your rental activities, if the income and expenses from rental activities are mixed in with your personal accounts, then your books are basically a mystery novel. You're going to have to go hunt and peck through all of your personal transactions to try to pull out the income and expense for your rental properties. So how do you fix this? Well, first open a separate bank account and debit or credit card for each entity, or at least for your rental activities. Maybe you group them. Make sure you pay the property, or make sure you record all the income and pay all the expenses using that account. If you need to put in cash, label it as an owner contribution. When you take it out, label it as an owner distribution. Why this matters, it's because a clean separation of your personal accounts and business or rental accounts, it helps protect your deductions. It simplifies your bookkeeping, helps your attorney protect your liability. It helps keep that liability shield intact if you're using an entity such as an LLC. So it's very important that you keep the personal funds and the rental or business funds separate. The next one is the what I call the I'll remember that method, meaning you're not really keeping proper records. So shoeboxes full of receipts are not a system. Your rental is a business, so you need to track it like one. So the fix for this, set up an accounting software or app. It could be QuickBooks or Stessa, REI Hub. There's several options out there. Make sure you're tracking receipts. Take a picture of your receipt on the spot and then just tag it by property and categorize it in your bookkeeping system. Keep a document folder. You use like a Google Drive folder or something similar with all of your settlement statements, leases, insurance contracts, your property manager agreements, W-9s from vendors, all of that stuff. Create one for each property and just track it and have it accessible, because you never know when you're going to need it, and having it in one centralized location is best. And set a monthly date with yourself to make sure you reconcile your bank accounts, review your P&L, find missing receipts, and just take, spending 10 or 15 minutes doing that now. It beats trying to cram it all together and spend 10 hours when you're trying to get your tax documents together to file a return. Next item is confusing repairs with improvements. So repairs, think of it as fixing what's broken, are usually deductible now. We like that. Improvements, we refer to these as betterments, adaptations, and restorations. So these are capitalized and depreciated over the life of the asset. So some examples of repairs would be things like patching a leaking roof. That's an immediate deduction. Replacing some broken tiles or fixing a broken window, deductions. Now, if you replace the entire roof, that's an improvement. It needs to be capitalized. Are you converting a garage into an ADU? That's an adaptation. So that's an improvement. So just be sure you're tracking things. And if you're not sure, flag it and make sure you talk to your CPA. There are 3 safe harbors that allow you to treat an item as a deduction. So we have the de minimis safe harbor. You can expense items up to $2,500 per item, or $5,000 if you have audited financials. Most small businesses and real estate investors do not have audited financials, so they're stuck with the $2,500 limitation. There's the routine maintenance safe harbor. So if a repair is necessary to keep the property in operating condition and is reasonably expected to occur more than once every 10 years, you can typically deduct that. So think of like replacing carpets when there's a tenant turnover. That's going to fall in this routine maintenance safe harbor. The third is the small taxpayer safe harbor. So for certain smaller rental properties, you can deduct annual repairs and improvements up to the lesser of 2% of the building's unadjusted basis, or $10,000 if you qualify for this. So just make sure you document what you did and why it's a repair. So a little sentence or note in your records can save you an hour if you're ever subject to an IRS examination. Next mistake I see a lot is forgetting to split land and building. So land doesn't wear out, buildings do. You depreciate the building. If you don't allocate the purchase price between land and building, you're going to end up over depreciating the building, which can get you in trouble with the IRS. An example of how this math works. So let's say you buy a property for $400,000. The land value is say 20%. That means the building is the remaining 80% or $320,000. $80,000 is allocated to the land and not depreciated. So the building depreciation, $320,000 divided by 27 and a half years, assuming it's residential, gives you about $11,600 of depreciation per year. That land stays out there and is used as cost basis if you ever sell the property, but it's not depreciable. Also be careful with the placed in service date. So you start depreciation when your property is available and ready to rent. So it's not necessarily the closing date when you buy it. Also, keep an eye out for cost segregation opportunities. So certain items like carpeting, appliances, just different land improvements, they're depreciated over shorter asset lives and are also eligible for bonus depreciation. So you don't want to miss that. And if you did miss depreciation or miss doing a cost seg, you can go back and usually address that with a Form 3115, a change in accounting method, and get a one-time catch-up. The next item is ignoring passive activity loss rules or capturing them incorrectly. So many investors will think, my rental lost $30,000. I'll be able to offset that with my W-2. Maybe not. Most investors will not. So the rental activities are passive by default, meaning passive losses could only offset other passive income. Now, there's a special allowance of up to $25,000 if you actively participate and your modified adjusted gross income's under 100K. This phases out and it's totally phased out when your income or your modified adjusted gross income reaches $150,000. Other ways to deduct passive losses are qualify as real estate professional. That opens up the door for some investors, but not every investor is able to do that. And there's also the short-term rental loophole. But in general, if your losses are passive, they're limited, and any unused losses will carry forward to offset future passive income or gain on the sale of the property. Next big item I see that is misunderstanding real estate professional status. So we review returns all the time and see people using real estate professional status when it doesn't apply. So it's not available for every investor. There are strict tests, and it's a highly audited section of the IRS code. So to qualify, you have to spend more than half of your time in real property trades or businesses. And you have to work 750 or more hours in those real property trades or businesses. After you pass both those tests, you also have to materially participate in your rentals. And usually you're going to have to group rentals if you have multiple to achieve the material participation threshold. So a lot of mistakes I see are there's individuals who will count their investor type time, like educational courses, going to meetup groups, traveling to seminars, counting those towards real estate professional hours, and those will not count. Another big mistake I see is not keeping a contemporaneous time log. Really need to document your hours when you're going for real estate professional status. And then others is forgetting to make the grouping election to combine your rentals for material participation. Default rule is you have to materially participate in every single property. However, there's an election for real estate professionals that allow you to group those activities into one, so you only need to materially participate in your rentals in aggregate. So to qualify, if you qualify as a real estate professional, you can treat your rental losses as non-passive, very powerful result. but make sure you're doing everything correctly and able to prove that you qualify. Next common error is using the wrong entity. The entities you use can really make or break things for you. So just a quick framework. So long-term rentals usually going to be held in an LLC to help limit liability. For taxes, the LLC doesn't do anything for you. It is strictly a state level legal protection that you use to help limit your liability and protect your assets. The single member LLCs are considered disregarded entities, taxed like a sole proprietor. Multi-member LLCs file as partnerships. S corporations, usually not a good idea for holding real estate, almost never. There's basis and distribution issues, payroll complexities to deal with. Generally want to keep your buy and hold real estate out of S corporations. And we've done an episode on this before in the past, so I'm not going to go into any details here. But if you're flipping or wholesaling, doing property management, now these are active trades and businesses. So an S corp here would often make sense because it can help manage your self-employment taxes for that operating business, but it's not the properties themselves. So you don't want to trying to move properties in and out of an S corp without advice. Never a good idea because you have built-in gain and transfer issues that can really end up resulting in a nasty tax bill. Now, our next item is the short-term rental. So treating a short-term rental like a long-term rental. See this one a good bit. If the average customer stay is 7 days or less, the IRS, for passive activity loss rules purposes, does not treat this as a rental activity. It changes how loss deductions come into play. And in a good way, if you materially participate, you can deduct your losses on your short-term rentals without qualifying as a real estate professional. But also things I see that are missed a lot. There are other special things you need to consider when going the short-term rental route. So there's occupancy and hotel licenses that might apply. Local licensing can apply. That gets missed a lot. Make sure you're keeping a report or using a booking platform that helps you track the length of stay, track your hours of material participation, get depreciation right. This is one I see people often miss. They'll treat their short-term rental like a long-term rental for depreciation purposes. They depreciate over 27 and a half years, where short-term rentals depreciated over 39 years. Next common error we see a lot is 1031 exchanges where you miss the deadline. 45 and 180-day deadlines can be missed and blow up the deal. And usually that's a result of not planning in advance. And there's also issues with boot that can trigger tax gains for those that aren't paying attention. So 1031 exchange, as a reminder, lets you defer gain by kind of swapping into like-kind investment property. But the two timelines you have to consider are the 45 days to identify your replacement property, and you have 180 days to close the entire transaction. You have to use a qualified intermediary. A good qualified intermediary is going to help you and work with you so you don't miss these deadlines, but they can't do it for you. You want to make sure you start lining up lenders and intermediaries and properties before you close on that first sale and the clock starts. There's also something called boot. So if you take any cash or if you reduce the debt too much, you might end up having a portion of the gain taxable up to the boot received. So just make sure that you're aware of that and planning ahead. If you keep it totally tax-free, you're generally going to trade at least even or up. Most people will trade up. If you trade down and you receive some cash, that's fine. It doesn't hurt. It doesn't impact the other 1031 portion of the exchange, but that amount of cash received is going to be taxable as if you sold a portion of the property. So it doesn't blow up the 1031 exchange, but know that there is potential to trigger tax in one, and just being aware of that is important. So another one that we see a lot, or some common errors we see here, are just not capturing your startup and organization costs. So as you get started, you may start incurring expenses before you acquire the property. This is where another area where good bookkeeping comes into play. Because if you're running everything through your bookkeeping system, you're generally not going to miss items like this. But things like advertising, traveling to find a property, legal fees to set up your LLC, and other startup costs, these can all be deducted once your business starts. Typically write off most of it in year one. If you have a significant number of startup costs, a portion will be amortized. But Again, just important to track this stuff. Next item is flippers being treated like investors and vice versa. So if you're flipping with the intent to sell, your properties are generally considered inventory. That's ordinary income, and it's subject to self-employment tax. Great place for using an S corporation. However, hold long enough as an investment, your properties are going to generally be taxed at the capital gains rate. There'll be some depreciation recapture on what you depreciated, but the capital gains are more beneficial to a taxpayer than having the income tax as ordinary. So you got to be careful here. So things to pay attention to are be clear with your intent. Pay attention to your holding period, the volume of activity, how often are you doing this, and marketing also a big factor here. So keep your activities and entities separate if you're doing both. We have clients that do both all the time, not a big deal, but we advise generally using two different entities, one for your buy and hold real estate and a separate entity for the flips. Another big thing we see there's state and local issues that get missed a lot. So it's not just the IRS that's watching your business and rental activities. Don't forget state income taxes. Now that's generally going to be filed with your tax return, but there's gross receipt taxes at city and county levels, personal property tax, local occupancy taxes for short-term rentals. These aren't things that get filed with your tax return in April. They're in addition to, and each locality has different deadlines for various filings. So it's just important to stay on top of all this because your rental property really you need to treat it like a business because it is a business. A few other miscellaneous things is no capitalization policy. To use that de minimis safe harbor and deduct repairs up to $2,500, you have to have a written policy in place confirming that de minimis threshold and that you capitalize things that are over $2,500 and expense those below it. Without a written policy, technically you're not allowed to use that safe harbor. Skipping closing statement reviews. So there's acquisition costs that get misclassified all the time. Some go to the basis, some are expenses. And you need to go through that closing statement to know for sure, or have your CPA go through it with you or for you. And then missing things like insurance reimbursements and deposits. So your security deposit's not taxable income, but you do need to track that. That should be tracked on your balance sheet if you're using a bookkeeping system. So little things like that. Again, if you do nothing else with this, but some things to take away, so just one, separate and systematize. Make sure you have a separate bank credit card accounts for your rental business. Turn on the auto bank feeds in your bookkeeping app. Document and save a copy of your capitalization policy. Make sure you're doing the correct land and building allocations and hopefully using a cost segregation study to help you accelerate your depreciation. And make sure you scan and store invoices with notes. Very easy now with smartphones. Take a picture, save it to a drive where you keep all of your receipts. Save it to your bookkeeping app. QuickBooks and many others allow you to attach pictures now or receipts as documentation with your transactions. And then, last but not least, plan for the tax year. If you have to pay estimated taxes, estimate your income, set up quarterly estimates if necessary. If you're considering real estate professional status, short-term rental loophole, make sure you've got an hour tracking system to log your time. If you've got an upcoming property sale, make sure you're meeting with your tax professional and look and see what the tax hit's going to be. Does it make sense to cash out? Do you do a 1031 exchange? Structure as an installment sale and carry paper? These are all things that you need to consider, and you want to do it sooner rather than later before the end of the year. That's where the tax planning and strategy stuff comes into play, and it's really, really important and good to do if you're serious about your real estate investing. But that about does it for today on the biggest tax mistakes we see, or I should say most common tax mistakes we see with real estate investors. If you like this episode, share it with a friend, hit that like and subscribe button. Until next time, have a great day. Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.